Imagine spending millions to buy a struggling public company, not for its business, not for its product, but for its tax losses. Sounds clever, right? Well, that's exactly what Total Energy Services tried to do. But when CRA looked closer, the tax code saw something very different. Hi, I'm Amandeep Singh, CPA and CEO of Cloudiver CPAs in Burnaby. My firm helps business owners and corporations navigate complex tax rules, and cases like this one reminds us how critical proper structuring and documentation are when losses and acquisitions are involved. This story starts with a failed biotech company named Xilix Biotechnologies. It had no business left, no staff, and no real assets, just a big pool of unused tax losses worth more than $75 million. Two businessmen saw an opportunity. Through their investment company, they took over Xilix under court supervision, cleaned up its debts, and renamed it Biomerge Industries. Their goal was to market Biomerge as a clean public shell company, something that could be sold to a bigger player looking for tax attributes and a stock exchange listing. On the other side, we have Total Energy Service Trust, a successful oilfield business group operating through an income trust structure. But when new federal rules, known as SIFT rules, came in, income trusts were about to lose their tax advantage. Total Energy wanted to convert into a corporation and do it quickly. Now, through investment advisors, Total Energy was introduced to Biomerge, this clean shell company with massive tax pools. They agreed to merge using a plan of arrangement. Total's trust units were exchanged for shares in Biomerge, which was renamed Total Energy Services Inc. And after all the restructuring, the trust was wound up and its assets and profits were rolled into a new corporation. And on paper, everything looked neat, but CRA saw that Total had effectively bought Biomerge's tax losses and used them to reduce its taxes in 2010 and 2011. CRA said this was loss training, something Section 111 of the Income Tax Act is designed to prevent. This section says that if the company's control changes and new owners start using its old losses against new profits, those losses are actually denied. Total Energy argued that there was no acquisition of control in the traditional sense. They simply converted from a trust to a corporation using rules known and allowed under the Act. They said the losses came along naturally as part of the process. But the tax court looked at the results, not just the paperwork. Justice Pizzitelli emphasized the General Anti-Avoidance Rule, or GAAR, a powerful tool CRA uses when a transaction follows letter of the law but still goes against its intent. The judge found that both the cleaning of Xilix into Biomerge and the later merger were part of one continuous plan to preserve and sell tax losses. The price negotiated, about 5 cents per dollar of tax losses, made that purpose clear. Even though Total claimed business reasons for the merger, the evidence showed that the primary motivation was to access Biomerge's huge $75 million losses and the fact that almost all of Biomerge's original shareholders were cashed out and 99.8% of the new company was owned by Total's unit holders meant the old company identity was gone. Only its tax attributes remained. The court concluded that the transactions fundamentally transformed the old biotech company into something entirely new. There was no real continuity of business, ownership, or purpose. And as a result, using those losses was abusive tax avoidance under GAAR. Total's appeals was unfortunately dismissed and the losses, nearly $26 million in non-capital losses, $23 million in shred expenses, and other deductions were denied. For business owners, this case is a powerful reminder that when acquiring other company, you cannot assume its tax pools or shred credits will survive just because the paperwork allows it. You see, the CRA and the courts will look at why the transactions happen, not just how it was structured. If the purpose is primarily to use someone else's losses, it risks falling under GAAR. CRA's audit teams today are much faster at identifying these patterns, especially when transactions involve cash flow mismatches, empty corporations, or unusual price per tax attribute details. At Cloudiverse CPAs here in Burnaby, our team helps businesses plan mergers, reorganization, and loss utilization in a compliant way. Think of us like Google Maps for your corporate taxes, showing every legal route, highlighting potential detours, and helping you avoid costly traps like this one. We focus on ensuring your structure aligns with CRA's expectations, your financial records report the tax positions you claim, and your transactions have genuine commercial purpose, not just paper benefits. The total energy case shows that even large corporations can run into trouble when tax planning gets too aggressive. With the right accounting guidance, you can achieve tax efficiency without crossing into risky territory. Thanks for watching, and I'll see you in my next video. Until then, bye.